My name is Sydney Taylor.
And my name is Lisa White. And in today's presentation, we'll outline the history of public banks in Costa Rica, give an overview of the public banking system in the country today, and then report how Banco Popular has met the majority of the core features under Maria Jose Romero's 4 pillars for public development banks. After the 1948 Civil War, Costa Rica was desperately poor, and Jose Figueres realized there would be more civil unrest in the future unless something was done to relieve the poverty and deprivation of rural populations. He formulated a plan in which the public sector would be financed by profits from state-owned enterprises, and the private sector would be financed by state banking. Costa Rica nationalized all of its banks and imposed a monopoly on deposits in 1949, thus putting credit under government control. Effectively, only state-owned banks existed in the country, since they were the only financial institutions that could offer checking and savings accounts to the public. The monopoly was loosened in the 1980s and was eliminated in 1995. Instead of reprivatizing the banks that were nationalized under Figueres, President Ulatu allowed private banks to operate in competition with the nationalized banks. In the 1950s, various industries and activities were brought into the public sector, including banking, utilities, railroads, health facilities, public housing, higher education, land management, and the social security system. During this time, a large number of state-owned capitalist enterprises were also founded. Their profits were returned to the national treasury, and they financed dozens of major infrastructure projects in the public sector. At the same time, many Costa Ricans were working for small mom-and-pop companies that were suppliers to the larger state-owned firms. It was state banking that made the founding and growth of those small firms possible by offering credit on favorable terms. Had mom-and-pop companies been forced to rely on private sector banking, few of them would have been able to obtain the financing needed to become established and prosperous. Therefore, state banking was key to growth in the private sector. Lending policies were backed by government policy and designed to facilitate national development rather than pad local bankers' wallets. In the 1980s, when Costa Rica began borrowing money from the World Bank and the IMF to pay down its national debt, these multilateral organizations imposed neoliberal conditionalities such as austerity measures throughout the country. Indebted to the IMF, the Costa Rican government had to privatize its state-owned enterprises, drastically reducing revenues and depriving the public sector of its primary source of funding. However, state-owned banks remained open in spite of enormous pressure by the IMF and the US to privatize them along with other public assets, since the Costa Rican government was able to secure financial aid from other donors. Since the 1990s, private banks have frequently closed, often due to corruption or embezzlement scandals, and depositors in them have inevitably lost most of the value of their accounts. However, Costa Rica still has a robust economy and is much less affected by fluctuations in the global economy than neighboring countries, because most of the country's money is kept in stable, state-owned banks that carry the full faith of the Republic of Costa Rica. Money in these banks is readily available for lending, and local businesses can get access to credit when they need it. Local businesses were even able to obtain financing throughout the 2008 financial crisis because most lending activity is set by government policy, not by a local banker's fear index. There are currently 29 licensed banks, mutual associations, and credit unions in Costa Rica, of which 4 were established as national publicly owned banks in 1949. These 4 public institutions consist of 3 state-owned commercial banks and a special charter bank, which is Banco Popular, which in principle is owned by all Costa Rican workers. National state-owned banks have some security since they are backed by the Costa Rican government and deposits are insured. The 4 state banks compete fiercely with each other, and because they are stable and none have failed in more than 30 years, they're trusted, and most Costa Ricans have moved the bulk of their money into them. According to a 2003 World Bank report, public banks dominate Costa Rica's onshore banking system, since the 4 state banks hold about 80% of retail deposits in the country, and the 25 private institutions share the rest amongst themselves.
The Banco Popular was founded by the government in 1969 and operates under public law as a worker-owned bank, committed to the collective welfare of society to promote growth and provide economic security to the country's workers. The BPDC is considered a public sector bank that is lawfully owned by the Costa Rican workers. It is owned by 1.2 million Costa Rican workers, or approximately 20% of the population, which is perhaps the world's most democratic bank. The Assembly of Workers serves as its highest governing body, with 290 workers representing 10 different socioeconomic sectors. While the Assembly provides strategic guidance to the BPDC, the National Board of Directors, which is the bank's highest administrative unit, has effective control over daily operation. The Board of Directors of the bank is made up of 7 members, 4 from the Assembly and 3 from the government. The board currently has 4 women and 3 men on it. Therefore, it meets its criteria of having at least half of the members be women. This has given the BPDC a significant democratization distinction, since it was the first public organization in Central America to have at least 50% women in its decision-making bodies. The BPDC takes a triple bottom line approach to its activities, which includes the financial, environmental, and social aspects. Specifically, the bank's environmental and social priorities are balanced against the need to make a profit, another qualitative difference from conventional private banks. BPDC fulfills its mission of serving the Costa Rican people's social and sustainable welfare by effectively funding cooperatives and communities that are vulnerable to financial exclusion, such as employees, peasants, and small and medium-sized businesses. To ensure this, a quarter of the profits are directed to special funds that help those who would otherwise be unable to enter the banking system. For reference, Banco Popular collaborates with Copalesca, one of 4 regional energy cooperatives that has successfully electrified rural areas of the country. Copalesca completely switched to LED lighting with the help of a low-interest loan, and by 2015, the cooperative had offset its carbon footprint through its own renewable energy sources and other environmental initiatives. Copalesca was also aided by the worker-owned bank in its purchasing degraded land in order to conserve soil, habitats, and water supplies.
In summary, Banco Popular has met the majority of the core features outlined under Maria Jose Romero's 4 pillars for public development banks. The pillar of financial sustainability can be seen by Banco Popular's $5.4 million in assets. Good governance is demonstrated by the bank's democratic structure, where 290 representatives drawn from 1.2 million workers make up the Workers' Assembly, and 50% of the people in its decision-making bodies are women. The pillars of mandate and role and operational strategy have been accounted for by Banco Popular's triple bottom line and social and environmental mandates. In conclusion, Thomas Marois claims that there will be no just or green transformation in a financialized world dominated by a quote-unquote unaccountable and self-interested capital class unless financial capacity is first reclaimed in the public, not private interest. However, it would be a grave mistake to conclude that, since they are publicly owned, resurgent public banks will always act in the public interest. Public banks can and do make mistakes. It is necessary to compel public banks to act in the public interest. This transformation will require significant democratization, and since Banco Popular has been able to accomplish this transformation, it can be a model for public banks throughout the global south.